What is P2P lending? P2P lending is a form of lending in which individuals like you and me lend to other individuals through online platforms. Traditionally, this role has been played by banks. Banks take your money in the form of deposits and they give them out in the form of loans. So P2P lending cuts out the bank from the middle. Now, is P2P lending a regulated activity? And the answer is yes. P2P lending can only be done by platforms which are registered as NBFC P2P. That is, they have a license from the RBI as P2P NBFCs. What are the returns that you can get through P2P lending? If you look at the 2 or 3 big platforms that have enabled P2P lending, and they have done so usually through tie-ups with P2P NBFCs, you will find that they offer returns of 9 to 12%. For example, BharatPe has a 12% club. Cred offers returns of around 9%. And just last month, Fi, which is a new bank, made an announcement for P2P lending on its platform as well, again targeting 9%. Now, what are the risks involved in P2P lending? First and foremost, your returns are not guaranteed by the P2P NBFC. If the ultimate borrowers to whom your money is going, if they default, your money is gone. Now, what are the kind of borrowers who take money from such platforms? Money through P2P lending can only be given as personal loans, so not home loans, not loan against property, etc., which some might perceive as lower risk. So P2P lending is only personal loan and that can be higher risk. The other risk is in terms of simply platforms stopping flows depending on the supply and demand for loans. So BharatPe recently did this when they closed down their P2P lending for fresh inflows. Existing investors, however, of course, are receiving returns on their P2P loans. Finally, you have to consider the fact that there is no uniformity of reporting of NPAs on P2P platforms. So if you go to the website of different P2P platforms, you will find wildly differing numbers for NPAs. These are all the risks that are involved in P2P lending. Before you go, consider a few points about the fintech platforms that are involved. First and foremost, the returns of 9 to 12% that they have on their websites are up to those amounts. You can get returns of much less than that, and in fact, even your capital may not come back if defaults rise to a very high level. Second, think about how they make their money. So the answer is that they make their money just like a bank. They take money from you at 9 to 12% and they lend it out to people who are taking personal loans at 20 to 24%, and they therefore pocket the spread. But if the defaults rise, by no means are they guaranteeing your money. Now, of course, some of the fintechs have put some safeguards in place. For example, some of them stipulate to the NBFC P2P partner that the lending should only be done to a certain segment of high quality borrowers within the base of the P2P partner. Or it could be that the fintech says that you can only lend to its own users through the P2P partner. So there are safeguards in place, but your returns are by no means guaranteed.